Well, hi there. Welcome to the 7th edition of the online seminar, How to Read Tax Returns and Close More Loans. This is your host, David Kuiper, and I wanted to welcome you and let you know a little bit about what to expect from this seminar. Very minor changes from the 2011 edition, so if this is your first time, get ready for some fun. There's plenty of tax return classes out there. This one is intended really just to focus on you as the originator and understanding how to read and interpret a tax return, how to communicate that with your processor and underwriter, with your clients, and potentially with their CPA or whoever's assisting them with their taxes. So what I'd like to do is just kind of give you a quick overview. We're going to be taking a look at some very technical details, and you're going to be seeing 45 to 50 slides of IRS documentation, and it might kind of cause your eyes to glaze over a little bit and to tune out, but I wanted to make sure that you knew a lot of those forms we're not going to be doing much with. I just want you to be able to see them, understand why they're there. You're going to be seeing them when you're working with your clients and knowing what it is that you're looking at, why you need it, and a little bit about each form. So while this is going to be kind of technical in nature and not real fun and glamorous and sexy, I think you'll find it to be very helpful in your day-to-day practice. So this presentation is really designed to be an overview of reading tax returns and understanding the difference between taxable income and cash flow. It's going to help you interpret what true cash flow looks like, especially for the self-employed borrower. So there are entire 1- and 2-day classes that can go really hardcore, nitty-gritty, and get a lot more detail. Maybe check with your MI rep or something like that as an example. But today, what I want you to see is how an underwriter and how you as the originator should be looking at a tax return, and highlight the common areas that you're going to see time and time and time again. Understanding the why is huge. Why do we add something to cash flow? Why do we take something away from cash flow? Why it makes a difference, how it's going to be interpreted and used in the loan approval process. Sometimes you'll have a client come to you that says something like, my tax returns didn't look very good last year, or last time I did a stated income, good luck with that one in today's world, or I need to do no income verification or something like that. And some originators might just take that at face value and say, okay, that's what we need to do, or maybe go through the time and energy of collecting the documentation, that the tax returns, and then not knowing what to do with them or taking a look at them in the wrong way. What I've found is that typically you're going to find more cash flow than reported taxable income in a tax return once you learn to read the tax return. That's one of the beautiful things about being self-employed. Your cash flow, actual cash flow and income, is typically greater than the taxable income that's reported to the IRS. So one of the benefits of understanding this is that you'll be able to get more loans approved when you understand how to explain the tax return, how to interpret them, how to submit your loans with the correct income calculation the first time so the underwriter isn't second-guessing you. And once you've established that relationship with an underwriter that knows you know what you're doing, that you understand cash flow and tax return analysis, it can make your approval process a lot smoother. New slide. In addition, there's 3 more benefits in addition to having a smoother underwriter relationship and loan approval process, one of which is being able to provide better interest rates and terms for your clients by putting them into conforming product rather than pushing them into a stated income loan or a no income verification loan or some type of portfolio product, which can be fairly rare in today's world as well as more expensive. You'll likely be doing higher loan amounts because if you show more income for your borrowers, you can qualify them for more. Very often, the more affluent home buyer is a self-employed person or a business owner, so you'll be likely working with higher dollar amounts, and you'll be able to establish a reputation within the community of CPAs and financial advisors along with your builders and real estate agents. At the end of the presentation, I've included all of the forms that you're going to be seeing with detailed notes. So as you're taking notes during this course, keep that in mind that at the end you'll be able to access all the forms along with notes on each highlighted area that I'm going to be talking about. So we'll move kind of quickly through them here, but you'll be able to download them in an interactive PDF and take a look at a lot of these